Good morning again, everyone. Ron Bullis here, the CEO and founder of Lifeworks Advisors. I am really excited on this Friday, April 23rd, to get to share some thoughts around the market, the economy, things that are going on. There has been a lot of news lately, lots of headlines, and really excited to get to have this time today to share with you our team's thoughts on just what's going on. Title of my presentation today is Fear, Greed, and the Road Less Traveled. One of the repeat themes that we have in conversations with both clients, people like you guys watching, prospects, advisors around the country, is how to deal with the emotional impacts of being an investor in today's market, right? So when I think about all the conversations that our team has, two predominant emotions tend to come up over and over and over again. Fear. The fear of the market collapsing and losing all of your life savings, the fear of stepping into the market at the wrong time, the fear of choosing the wrong advisor, the wrong strategy. And then the other side of that, which is what's called FOMO, the fear of missing out, or greed. The greed one has definitely been on display for the last few months, if not longer, right? We've seen lots of news headlines around GameStop and the meme stocks, et cetera. People investing in assets simply because everybody else is, right? There's different digital assets, Dogecoin to be another example of one that's just had amazing run up in value and literally made people millionaires overnight without a lot of logic, reason, or let's say financial principles supporting it, right? Probably being driven mostly by people's greed. So I want to start today's presentation with a quote from a former president, Franklin D. Roosevelt. In his inaugural address in 1933, one of the lines in there that he said in his speech was, "The only thing we have to fear is fear itself." Now I want to read just the excerpt from the beginning of the speech, and I'm going to close my presentation today with a piece out of the middle towards the end of his speech. Here's what he said at the beginning of his speech. He said, "This is preeminently the time to speak the truth, the whole truth, frankly and boldly. Nor need we shrink from honestly facing conditions in our country today. This great nation will endure as it has endured, will revive, and will prosper. So first of all, let me assert my firm belief that the only thing we have to fear is fear itself. Nameless, unreasoning, unjustified terror, which paralyzes needed efforts to convert retreat into advance." Between the coronavirus pandemic, unemployment numbers, housing situations, global unrest, civil unrest, racial tensions, etc., there are a lot of things that lead us to reasonably have concern or fear. I've been traveling again the last couple months, meeting clients and prospects around the country, and obviously travel looks a lot different. We're wearing a mask everywhere we go in airports and airplanes. Some people disagree with it. Some people think we absolutely have to, but a common denominator that seems to be there is this element of fear, right? This element of we're living in uncertain times. I want to give a quick reminder to people about why Lifeworks Advisors has chosen to structure our investments a certain way and why we approach investing a certain way. One of the hardest things that we have to conquer as investors, both you and us, is to build systems and strategies that help us remove our emotions from our financial planning and our investment decisions. So I'm going to give two examples of prospects that I've talked to very, very recently. And if they're listening to this, because some of the prospects might be on this video as well, this is not a derogatory example. This is an example of something that we're seeing over and over again. The first example is this. Have a prospect, he's sitting all in cash right now. And he's been sitting in cash for several years because he's afraid to step into the market to invest his assets and then potentially see them all go down in value if the market collapses. And there's a pendulum here, right, or a continuum. One end of it is, the dollar loses its reserve status globally, the US goes into default, the entire financial system crumbles, and we go back to gold, God, guns, growing our own food. Let's put that on one end. The other end of the pendulum is just truly a fear of an economic collapse, right? As a result of letting fear drive how he is making his investment decisions, he's missed out on one of the greatest bull markets that we've had in the history of the United States. other side of the conversation is a prospect I had a conversation with just a couple weeks ago. And he said words to me like, I know I have to take less risk. I know I have to slow down. I'm afraid of my assets that I've saved for retirement getting cut in half. But yet then we talked to him about building an investment approach off of his family's rate of return and off of the very specific objectives he had. He said something to the effect of, well, I want more return than that. I don't want a 6% rate of return. I want to go for 10. And in that example, he was letting his greed keep him from potentially making decisions that were the right one for his family. So the road less traveled is the idea and is the structure and the systems of saying, we know why we're investing our assets. We know what our minimum rate of return target is. We have a system that we're following that's not led or driven by a risk tolerance questionnaire, by a talking head on CNBC, by an online news article, or by a Reddit group where everybody's talking about their favorite stock. We have a time-tested, disciplined approach for how we think about and actually act on making investment decisions. And it's not based on fear and it's not based on greed. So I want to talk about that a little bit more, but I wanted to start because I think we're sitting at a time right now where maybe half of the United States feels optimistic and the other half of the United States doesn't, as it pertains to a new presidential administration, policy changes, what's happening with COVID and the economy's reopening. And I just wanted to pause and reflect on fear, greed, and then the road less traveled. The road less traveled being having clear objectives for you and your family, and then having investment strategies and financial plans that are designed to support those, where we can turn off the noise that we hear, again, 24-hour news cycle, online journalists and publications, talking heads on different, money shows. We have to turn all that off and we have to get very, very clear and very, very focused on what it is we're trying to accomplish and where it is we're trying to go. So in my presentation today, as I give a market update, I just want you to kind of be sitting on this a second, right? How do you feel about the economy, about the current presidential administration? What are your emotions right now? Because all of us have to get really clear on what those things are so that as we approach making decisions, right, we can try and turn as many of those things off and focus on the objectives and focus on the strategies that we've put in place to implement them. So I'm going to shift gears a little bit here, but I wanted to start there, put a pin in this idea of what's your emotions right now and how are you feeling and thinking about this, right? And then we're going to go through some economic data. We're going to talk about federal spending, Federal Reserve actions, unemployment, inflation. These are some things that we constantly talk about on our market updates. We're going to give some updates here. But as we're going through some of these things, I want you just to be thinking about, right? How do we put our emotions aside and how do we stay the course? How do we stay on the road less traveled? Okay? All right, so let's get it kicked off here. Favorite topic of mine, federal government largesse, now called stimulus spending, right, or stimulus. Since the COVID pandemic began, we've had 3 stimulus bills passed that have been specifically addressing this. Roughly $5.5 trillion plus or minus $500 million, right? Which is crazy to think about, but plus or minus maybe $500 million. We've had about $5.5 trillion of federal government stimulus specifically to try and combat the economic issues and the uncertainties in the market because of the lockdowns, in the COVID pandemic. On the other side of that, right, this is kind of like a brother-sister relationship, the Federal Reserve, which is not part of the federal government, right? It's an independent organization. The Federal Reserve increased the money supply, essentially created money, printed money. And from what we can see by looking at the Federal Reserve's balance sheet, it's something like $3.5 to $4 trillion of new money was created in the last year as well. So you put those two numbers together, and we're just shy of about $10 trillion of economic stimulus, government largesse, and the Federal Reserve just creating money. So one of the questions that just sits with me as I see these numbers is, where did it go, right? The average American got stimulus checks, right? And probably got 3 of them. If you add up all of those stimulus checks, and if you assumed every American got every one of those, that accounts for about 10% of these dollars, right? So one thing to note here, maybe an economic lesson, little post-it note here. is government spending doesn't necessarily translate one for one into economic growth and GDP. Because if it did, the $10 trillion that's been created and spent would have turned into $10 trillion of positive economic output, and that's not the case. Two quick graphs here to highlight this point. The first one is the Federal Reserve's money creation. What you're looking at here, and for the Federal Reserve, it shows up as their liabilities. This is essentially currency in U.S. paper currency. These are bank demand deposits. These are deposits at Federal Reserve banks. We know that at the beginning of 2020, right, we were about $4 trillion of assets were sitting on the Federal Reserve's balance sheet. This was a 4x from where we started pre the Great Recession in 2008, 2009, okay? So over the last decade, the Federal Reserve has 4 times the money supply, 4x the money supply. And then from 2020 to now, it's doubled it, or almost a double, okay? Now, I was teaching my 8-year-old the other day, trying to give him a concept of what inflation means. He heard me talking about it with somebody, and he asked the question. And so I was trying to use the analogy of, hey, if we have a pizza and we cut the pizza into 8 slices, everybody, if there was 8 people, all 8 people could get a slice. He's like, okay, got it. I said, now let's just cut the pizza into 16 slices. And his first reaction was like, well, don't do that, Dad. That means I have a smaller piece. It's like, yes. If I could just capture that in the 8-year-old simple language and say, this is what happens when governments just create more money. The gross domestic product, the economic output didn't change, but they just changed the denominator. They sliced it into a lot more pieces. We haven't seen fully the impact of this yet because this is an inflationary pressure. So we're going to be talking about inflation and reflation, stagflation, a couple of key concepts in just a second, but just know that this is unprecedented money creation for the US government. If you're a student of history, you can go find some of the times in history where governments have created currency, and the outcome of that has always been pretty bad, pretty tragic, right? We don't have time to cover a history lesson today. Some of you guys know me well and know that's a passion of mine as well, but we'll maybe get to that sometime in the future on another one. U.S. debt. This is not actually the dollar volume of the debt. This is a measure of the U.S. total debt to our GDP, or our gross domestic product, which is kind of the broadest measure of the U.S.'s economic output, okay? If we rewind just a few years, we would have been seeing our debt levels at about 50% of our GDP, okay? We are now at about 130% of our GDP. And this is before we spend another $2 or $3 trillion in infrastructure spending. This is before we raise corporate taxes and capital gains taxes, which hopefully won't happen, but it's looking likely that it might. I'm going to talk in detail about that at the end of the presentation. This is assuming all continues to go well and the economy recovers. Now, nobody knows, myself included, at what level the U.S. federal debt can actually be sustainable. Some people would have said at 100% GDP, we might have already crossed that Rubicon. If we look at Japan or other countries, they're well in excess of that. But this is an unknown question, and anybody that says they have the answer to this, whether, again, they're a politician, a talking head, somebody from the Federal Reserve, it's an impossible thing to know. But what we do know by looking at history is when you start seeing debt levels at the government level like what we have now, it's starting to get into red zone territory. It's dangerous for the economy. It's dangerous for governments. Quick point here. I won't get too boring in looking at this. Here's a snapshot of the Congressional Budget Office, the CBO's projections for the next 10 years. How accurate their projections have been historically, right, set that aside a second, but this is what they're projecting our budgets to look like. Interesting thing to note. We're projected to collect $3.5 trillion of tax receipts. I hate using the word revenue. They use the word revenue. The government isn't a business. They're really just taking our money. We're the ones that generated the revenue, but okay. So we're projected to collect $3.5 trillion of tax receipts this year, okay? They're projecting to spend in 21 $5.7 trillion. Again, this is before any infrastructure bill is passed, any green energy, type of bill, the new Green Deal is passed. This is as it sat in February of 2021, okay? But what's more important in here is the net interest cost. if you've been a client of ours for a while, if you've watched these market updates before, you've seen us talk about the fact that we are at 40 or 50-year historic lows in interest rates, okay? Since about 1984 till today, interest rates have just been falling precipitously in a very, very predictable trend line, okay? The U.S.'s budget office, the Congressional Budget Office, is using current historic low interest rates to project the interest costs for the federal debt, okay? So just roughly, here's how the federal government spends their money. About a third of it goes to Social Security. About a third of it goes to health programs like Medicare and Medicaid. About a third of it goes to welfare and social income type of programs, okay? So that's a third is 100%, roughly. Then you have another $1 trillion for defense, and then everything else piled on top of that, okay? At a $30 trillion level of federal debt, if interest rates were to return to historical averages, at our current budget, we'd actually be spending another third of our budget just on the interest cost. So eventually it might get to a spot where it's a snake eating its tail kind of thing. The government's gonna have to go into further debt to cover their existing debt, to cover more interest payments, to go into further debt, et cetera, et cetera, et cetera. Why do I point this out? Well, I point this out to kind of highlight the fact that the U.S. federal government's financial house is anything but in order, right? And again, nobody, including myself, knows what the long-term implications of this will be, or even what the short-term implications of this will be. But we do know that this is something that we should be paying attention to, right? As investors, as citizens, those are, sometimes two different things. But as an investor, we should be thinking about, what does this mean for owning assets that are going to have real value over time? What's likely to be the outcome of Treasury spending, of Federal Reserve actions, of politicians, if we continue down the financial path that we've been on? Here's the last thing on this. The Congressional Budget Office is using these interest rates that you see here on the screen to create the estimated interest expenses for the federal government for the same 10-year period. And this is right from the CBO's current budget projections. Now, it's not to say that they're thinking that interest rates in 2024 are going to be 1.3%, but this is what they're estimating the average net interest cost will be on federal debt. What happens if they're wrong? Right? We could also look at this and see that the Congressional Budget Office is expecting interest rates to stay stagnant and flat for the next decade, which for people in retirement, for people that need to generate income on their portfolios, has interesting implications. All right, disinflation, reinflation, or reflation, and stagflation. Let's put a couple of definitions here in place real quick. Disinflation is a term that you're not going to hear a lot, but it is something that our team talks about. This is the idea that prices are increasing, but at a very low and slow pace, okay? Inflation is the fact of prices increasing over time, and then hyperinflation would be they're like rapidly rising, right? So disinflation actually is advantageous. It means prices are increasing slowly, the economy is growing at the same time. That's good for consumers. It means we have more money, rising wages, better financial situation, but yet prices are staying fairly consistent or slowly growing over time. This is where we've been. We've been in a disinflationary environment for the last, 10 years. Interest rates have stayed relatively flat, the economy's grown, financial markets have appreciated, prices haven't changed a lot. That was a good thing for consumers. That regime change has now shifted, okay? Where we're going now, and you might have seen this online, you might have heard talking heads kind of pontificating about this, is this idea of a reflationary trade. Well, what does this mean? Well, it means we're moving back from being in a disinflation environment to going back into an environment where we're expecting significant increases in inflation over time, positive increases in inflation, okay? This has huge implications. It should have massive implications on interest rates, although the Federal Reserve and the U.S. government are doing everything they can do to keep interest rates low for the reasons I mentioned in the budget charts before, right? But it also has implications for us as investors and as wealth management advisors when we're thinking about, should we own fixed income and bonds? If the average coupon rate on a U.S. Treasury is, say, 2% a long-dated U.S. Treasury note, but inflation's 3, we're losing 1% on that in real terms, right? So we have to be conscious about this. These are the forward-looking inflation numbers based off of Treasury projections, okay, implied by Treasury yields. So this is the regime we're going into, a world in which there is expected inflation, okay? I'm going to jump past this one a second here, and I'm going to give a couple examples of inflation. I'll come back to the definition slide in just a second. If anybody's been following the housing market, right, there's multiple reasons to this, but home prices have been accelerating rapidly. Now, home prices shouldn't accelerate rapidly when you're in a time of significant economic decline. So in 2020, when the governments across the world and in the US and at the state levels shut down the economy, and we saw massive unemployment, right? We should have seen a pullback in home valuations, but we didn't. We saw an inflationary push in home prices. If you travel anywhere in a car and you buy gasoline, you've noticed that from a year to a year and a half ago to today, gas prices have moved up significantly. Now, they're not at anywhere near all-time highs in terms of, current dollars, but they've appreciated significantly. I mean, 1 year ago, we were seeing gas prices still coming down, and since that time, they've moved up probably 60, 70% from the lows last year. So gas prices have been increasing. Lumber and building supplies, absolutely through the roof. I could put chart after chart after chart up here of other areas of the economy, food prices, other commodity prices. Semiconductors, chips, transportation costs, shipping costs. Lots of things in lots of different sectors in the market are having significant price pressure and price increases, which is inflation, okay? So when we are thinking about this, part of the challenge is, do we want to own assets like a treasury bond, for instance, or a 20-year municipal bond that's paying 2% when we're looking at different aspects of our economy and saying those prices are going up at 10%, 20%, 30% a year, and overall inflation might be 4, 5, 6%, right? So when we think about returns on fixed income, returns on assets in what we would call real dollars or real terms, which is adjusting it for inflation, there's a lot of places in the market right now that have negative real returns. For you, the investor, and for us in our capacity, that's just not something that's acceptable, right? That's not something that we can just sit by and be okay with, right? Meaning taking a very traditional approach and saying, well, I'm going to have half my assets in stocks and half my assets in bonds might mean that half of your portfolio is going to be at a loss in terms of real returns. And that's one of the reasons why Lifeworks doesn't do that and why we don't take a broad brushstroke to building our investment strategies for our clients, right? It's why we have downside protection and we have true diversification, because we look at bonds and fixed income and say that's not going to do it right now, okay? All right, so I'm going to put this one up here just a second, and these are kind of the definitions of inflation, reflation, et cetera. I've covered some of them already, but the key points, the key takeaways here is that the stimulus that's been baked in, the federal government spending that they're projecting has been driving inflation, or what talking heads will call reflation, or the reflationary trade. I'll talk about what some of the implications are in terms of where we should maybe be thinking about owning assets towards the back of the presentation. And if anybody has questions, on the side of the video screen, there should be, or right below the video presentation, right below my video screen, there is a little chat box. If you haven't seen it, you can feel free to toss questions up there. There's a few of my team that are on this market update, as there always are. They might be able to answer the questions. If not, they'll post them up here on my projector off to the side, and then I'll either answer them in real time for you, or we'll queue them up for the end of the presentation. All right, what's a possible outcome of where we're going? There's a word called stagflation. Lots of flations, I'm sorry. But let's pause on this one a second. Stagflation is the idea that prices are increasing, and maybe rapidly increasing, but the economy is slowing down and or the job market is stagnant, okay? An example of stagflation would probably be Japan. Their economy has struggled for years. Their interest rates have been flat, but they've had appreciation in prices, right? This is kind of the worst possible outcome for an economy to find themselves stuck in, right? Things are costing consumers more, interest rates are low, and the demand for jobs, goods, services is also stagnant. It's a little bit of a sinkhole that you can very easily get stuck in. So if we start to see inflation pushing higher, and if the job market and the underlying economic conditions don't start dramatically improving with it, I think we're actually headed towards a period of stagflation, where we're going to find our economy, we're going to find our markets in the place where things are going to start costing more, jobs are going to be less and less plentiful, and that's going to have significant implications on stocks, bonds, investable assets. Simple example would be if we start seeing stagflation, prices of goods and services starts going up, companies start raising their prices, but because the job market's soft, there's lots of people unemployed, the economy is stagnant, there's not new buyers stepping in to buy those goods, services, and products. The profits of the companies shrink or they go negative, right? And that theoretically should impact stock prices, right? That would impact financial asset prices. So this is not a good thing, but this is a high probability. I should back up. This is a likely outcome of the trajectory we're going. High federal debt, high federal spending, very soft labor market, increasing good prices, and inflation. All right, enough about that one. Let's talk about unemployment. This is a big one. So again, for people that have been clients of ours a while, we talk about inflation, we talk about debt levels, we talk about unemployment, right? And demographics, those are some of the big macroeconomic drivers that we're looking at regularly and that we're using to inform our investment strategies and our decisions. This is a long picture here of the unemployment rate in the US since the Great Depression, okay? Now, what we all know is the Great Depression, not what we had in this last year, completely different structure and setup. But a year ago today, roughly, we hit the highest unemployment we've had since the Great Depression. Now, since then, the overall unemployment number has come down, right? The current unemployment number is roughly 6%. And there's components to that we need to pull apart, right? Because when we hear that the unemployment rate's gone from 11% down to 6%, everybody should cheer that, right? But then we should also interrogate it and say, why? Well, we've had a lot of people leave the labor market, okay, number one. So we've had a shrinking of the labor market, which changes the percentages. Excuse me. It's not just as simple as everybody's going back to work. So a couple of slides to talk about unemployment, and then we'll move on to market observations. Weekly initial jobless claims. We talk about this one all the time as well, okay? Here's 20 years of weekly unemployment claims. And then here's March of 2020, this massive spike up. Highest weekly unemployment claims that we've ever seen since they started collecting data, okay? Now, the hope of all the politicians and the economists was that this would fall dramatically and we'd get back to normal, right? And while it has fallen quite significantly, weekly filing for new unemployment benefits, and this is new, so these are not continuing unemployment benefits, these are new filings, meaning somebody just lost their job a week ago or 2 weeks ago and filed for benefits. Right now, where we sit for new weekly unemployment benefit claims is still twice, almost 3 times higher than where it was pre-COVID. So we're just under 1 million people a week again are filing for new unemployment benefits, which means for us to sustain a 6% unemployment rate or for the unemployment situation to even improve, not only do we have to have that many jobs filled every week, but plus all the people that are looking have to have it filled. So one of the measures is to look at something through the Department of Labor, which is what are the number of Americans, what's the percentage of Americans, the total number of Americans who are receiving some type of supplemental income benefits as it relates to unemployment. So this is state unemployment insurance, pandemic unemployment insurance, emergency unemployment insurance. But this is the total number of people that are on unemployment benefits as of April. So again, we can see where we sat here right around the Great Recession, which would have been this peak right around January of 2010. Here was where we were at the right side of this slide from the initial implications of COVID. And we still sit at a spot where we're roughly 20 million Americans. It's just underneath that now. I think like 18 million Americans are collecting continuing benefits for unemployment. That's roughly 11% of the entire civilian labor force. So yes, the unemployment rate is 6, but we have about 11% of the civilian labor force collecting unemployment benefits. Scratch our heads there and think about that math a second, okay? Part of it is how they calculate unemployment, okay? One of the things that goes into the unemployment survey is they ask people if they're actively looking for work. Well, if somebody right now can sit at home, and in the state of Michigan, our unemployment benefits are something like $360 a week or something like that is the base benefit, plus the pandemic unemployment insurance benefit, plus the emergency economic one if they qualify for it. Somebody sitting at home right now on unemployment benefits might be collecting upwards of $1,000 a week in unemployment benefits. That translates to about $50,000 a year of income, which if you do some basic math and say that there's a 2,000-hour work week, that's a $25 an hour wage that somebody is collecting tax-free, sitting at home on unemployment benefits. Now, this is anecdotal, so this is not an empirical observation here. But as I've started traveling again in the last 3-4 months, right, I've noticed a significant increase in the price of getting an Uber, right? Going from the airport to a meeting, going from the airport to my hotel. And I've even been in some cities, and Grand Rapids, where we're at now, is one of them, where it's almost impossible to even find an Uber. Well, just think about this logically a second. Again, this is anecdotal. But if you can work 40 hours a week and make $500, $1,000, or you can collect unemployment benefits and make the same thing tax-free, right? Unfortunately, I believe that the unemployment benefits and the CARES Act and the subsequent stimulus acts that were designed to try and help Americans have created a perverse incentive for people to not try and get back into the workforce because they're making more money. And even if they're making the same thing, how many people want to go and sweat for 40, 50, 60 hours a week in a factory somewhere, or whatever the job might be, when they're still eligible for collecting benefits? So what we're seeing in talking to employers and like the number of job openings is that there are plenty of job openings available out there, but there are a lot of people sitting on the sidelines collecting benefits. So when you hear the news or when you hear a politician talk about unemployment rates improving and all that, say that's fantastic. Everybody should cheer that regardless of political affiliation. However, the full picture is we're still almost 20 million Americans collecting unemployment and just shy of 1 million new claims every week. That is not a healthy, robust economic data point, right? That is not us on the cusp of our economy getting ready to explode and have amazing growth, right? This has now created a challenge. What happens when the pandemic unemployment insurance starts to wear off? What happens if politicians just decide to keep it rolling? There's something called universal basic income, which is the idea of the government just guaranteeing everybody a minimum basic income. That's gained so much traction in the last couple of years as a possible viable policy outcome that what we might see is this kind of long duration of a significant population of people that are collecting benefits and not working. Okay, one more on unemployment, then we'll move on to something a little bit more rosy. These are alternative measures of unemployment. The one that the government is going to use is U3. Whoops, sorry about that. U3, which is right in the middle here of this. And this is where we see that we're sitting at maybe a 6% unemployment rate when we look at the standard definition of unemployment. When we look at U6, which is the one I've highlighted in orange here, right? This one actually is a more comprehensive and probably more realistic look. It includes all the people that are marginally attached to the workforce, which means working part-time for economic reasons. It includes discouraged workers, right? It includes people that are looking for a new job because their current job doesn't pay them enough to cover the bills, right? What it doesn't tell you, though, is the survey that is done by the Bureau of Labor Statistics here to try and calculate the unemployment number doesn't count people who say they're not looking for work. So however these surveys get filled out, ring, ring, yes, hello, Mr. Smith, are you looking for a job? Nope, I'm not looking for work. Okay, they don't consider that person to be unemployed. They consider that person to be not in the labor force. So I didn't have time to go through all the unemployment stuff, but if we look at the number of people in the labor force, it's actually shrunk significantly by multiple millions of Americans just in the last year. Okay. So the unemployment situation, I would say, is tenuous at best. There are tremendous job opportunities out there, but businesses can't fill them. So what are businesses going to have to do to fill them? Well, they're probably going to have to start offering a higher and a higher and a higher wage, i.e. inflation, which means then they're going to have to raise the prices of the goods and the services that they're producing, which is going to impact you and me and all the other consumers, right? Because at some point, they have to offer a high enough wage that the wage for working and the net benefits from working outweighs collecting unemployment benefits and stimulus checks. All right, let's talk about market data and some observations. I'm about a half hour in. I want to leave lots of time for Q&A at the end of this because there's a bunch of stuff that's come out in the last week with announcements about tax policies coming, things like this. Shift gears to talk about the market. Where do we sit right now? What we're looking at here on the screen is the CAPE ratio. It's the cyclically adjusted price to earnings ratio. This is something that Robert Shiller created years ago. He's a Nobel laureate for this. This is basically saying if you take the S&P 500, okay, and you look at the last 10 years of earnings, right, and adjust it for inflation, right, and then you divide that number into the current stock price, you get this ratio. So the higher the CAPE ratio or the higher the PE ratio, the higher the valuation of the company, okay? So what we can see here on the far right side of this slide is that the current PE ratio for the S&P 500 is 37.5, right? What it means is you're paying 37.5 times for every $1 of net revenue that the S&P 500 companies are expected to generate, you're paying 37.5 times that for the price of the stock. So a question we get asked all the time is, do we think the stock market's overvalued? It's almost an impossible question to answer accurately. Another way of putting it is like, how are valuations on the stock market or individual stocks today relative to history? Well, what you can see here from looking at this slide is that the only time in history, since this data has been being gathered, where the stock market has been more valued than it is today was the dot-com bubble, which would be right here, this peak, right around January 1, 2000. Okay? We all know what happened after that. So what this is probably caused by, there's a litany of things, but one of them is easy money. The federal government printing trillions and trillions of dollars, injecting it into the economy. The Federal Reserve printing trillions and trillions of dollars and de-risking a lot of the investments for the large banks and firms on Wall Street. In fact, the Federal Reserve has pretty much said, since March of last year, we'll buy, junk bonds, we'll buy traditional bonds, we'll buy muni bonds, we'll buy U.S. Treasuries from you. Hey, if you're a bank, you have no reserve requirements. Lend as much money as you want. Yes, it's true. The Federal Reserve, about a year and a half ago, or a year and a month ago now, dropped the reserve requirement for all U.S. banks. Banks can lend infinitely, theoretically. They're not. They're actually sitting on tons and tons of cash. But we live in a world where the federal government and the Federal Reserve have created so much cash in the economy. Again, anecdotal example, stimulus checks come in, people become day traders, go out there and start buying stocks. And we've been seeing this replicated for the last year. Billions, hundreds of billions of dollars of new money going into the stock market, right? When you have more buyers than sellers, when you have money that can be at risk, but it doesn't impact anybody if it's lost, right? You have a willingness to pay a higher and a higher price. Combine that with the fact that the interest rate on bonds is negative when you add in inflation. So for pension funds, endowments, family offices, large investors, they've been cycling out of fixed income and bonds and into more and more equities and more risk assets in search of yield. This has been driving the price up. We are sitting at a point right now where the S&P 500, the 500 largest companies in the United States by market cap, are now trading at 37.5 times earnings. Some of them are way above that. So the Teslas, the Amazons, etc. I mean, you're talking multiple 100 times earnings. What are the implications of that? Well, one, it means that they probably are overvalued when we look at historical measures of value. Two, it means that a lot of the future year's returns have been pulled into the present, okay? If normally, historical average price to earnings ratio for the S&P 500 is maybe somewhere 17 to 20, something like this, right? And now it's at 37.5. If it reverts back to its historical average, there's only a couple things that can happen. Either the company has to become way more profitable, which if we go back to the economic conditions we started the presentation with, right? Debt levels, unemployment, inflation, like that's going to be a challenging environment for companies to become ridiculously more profitable inside of. They can become way more profitable, or the stock price has to fall. Now, the alternative to not owning, say, equities, owning bonds again, we've already kind of pointed out is almost a guaranteed loser in the world we're in now in terms of real returns. So this is a challenge that all investors, from individuals all the way up to institutions, have been facing. But because the government has created an environment now, along with the Federal Reserve, where risk-taking is not only promoted and encouraged, right, but you put that alongside of fear and greed, powerful motivators for individual investors, and we see lots of possibility for bad things in the months and years ahead. Okay, now don't take this as a doom and gloom. This is just reality. This is where we sit today. Okay. Key takeaways: we're back to almost an all-time historical, highs in the stock market. This year has been, nothing but up for pretty much every asset class except fixed income. And at this point right now, it doesn't look like there's any end in sight, even with the recent announcements of increased capital gains taxes or the possibility of that in corporate taxes. We still see equities pushing higher. We still see a lot of net new money coming into the equity markets. And it's not like it's leaving the bond markets. When we look at net new money, right, it's not like it's leaving bond funds and fixed income and rolling over to equities. It's just new money, right? Part of that's because the federal government the Fed created tons of new cash. So some takeaways here. Year-to-date performance of S&P 500, as of the time we put this slide deck together, was about 12.8%. We see small caps outperforming right now. That's what's happened so far this year. We see energy absolutely outperforming, right? Go back to the slide I had about gas. Gas prices through the roof. Part of this is also people are traveling. Energy is being consumed more. So there's stuff there. Natural resources and financials, right? Small cap growth should be a sign of confidence in the economy. I think that is a part of it. Another part of it is, again, the moving of money from, say, a stimulus check to investing in the equity markets. And technology has made it so simple to do that a lot of people, I believe, are investing in the markets that have no idea of the actual underlying fundamental value of what they own or why they own it. It's simply they're doing it because it's been gamified, or because 6 million people on a Reddit forum decided to go into one stock, and next thing everybody did, and then the herd, the madness of crowds took over, and everybody went after that. Okay. Here's a few other annualized returns as of yesterday for some different major asset classes. We see that the U.S. Treasury bonds, right? We got 10 years, 30 years, and the Barclays Aggregate Bond Index. These are all negative for the year, right? And this makes sense. We have seen yields come up, right? And we see expectations of inflation. So going long, a bond right now with a low yielding coupon on it, when you're expecting inflation to be higher than the coupon rate, is, again, it's a guaranteed loser. So we've seen downward pressure on the bond market in both the U.S. Treasury sector and what we have on here, the Barclays U.S. Aggregate Bond Index, which is all the corporate and mortgage-backed securities, et cetera. Municipal bonds have been flat. Gold is down for the year. Commodities up. Small caps up, et cetera. I don't want to get lost here in this. I want to think about some kind of key takeaways, right? we had an entire market cycle last year, over the last 12 months. We've essentially had an entire economic cycle, which normally is like a 10-year or a 12-year run, condensed into a year, right? We had depression-era unemployment essentially created in early 2020. We had massive economic decline like we would have seen in a significant depression, or like what we had in the Great Depression, right? We had significant devaluation of currencies and assets across the globe. And then federal dollars and central bank dollars started coming in, stopped the market free fall, pushed everything back up, and asset classes took off, right? So we literally did an entire market cycle in a 1-year run. Now, it was a artificially created market cycle. It wasn't a naturally occurring one, right? So there's some dangers there, right? But our takeaway is this: no economist, no politician, no talking head, including us, knows what's coming next. And if there was ever a time in the history of being an investor, right, of having your life savings in the market, to have true diversification of your asset classes, it's now. If there was ever a time to have downside protection and hedging on your investments, it's now. And I'm not saying that because those are things that Lifeworks does for our clients. And I'm not saying it because it's the easy path. It's not. It's the road less traveled. When we buy an equity, for example, and we're owning it because we believe it's going to create long-term value for you, our clients, and it's considered today to be boring, right? Like Walmart or Coca-Cola or something like this. We're doing it very intentionally because we know that our job is to not just look at today, but to look at the possibility of what's coming tomorrow and then into the future. When we buy puts and when we buy downside protection for you, our clients, and we hedge those, and we know that that comes at a cost, that comes at a cost of reducing the long-term performance of the equity. We're giving up some upside. But the road less traveled is looking at these things and saying, how do I stay disciplined? How do I make sure that the investment dollars we have that are created here for you guys, our clients, are going to be here tomorrow and the year after that and the year after that and the year after that? Simply owning stocks and bonds is not going to create diversification. In fact, we saw a year ago, all of those things fell at the same time. Sitting on cash in the full-on fear mode is not going to work either. Because we know there's a couple of things. One, if that was the strategy that we had for our clients, and it's not, but if that was the strategy someone was following, it's likely they're not going to get back into the market at the right time anyway, and they're going to miss out on the turn. They're going to miss out on the growth. The other side is if they're sitting in cash and cash is paying 0 interest, maybe 0.05%, 5 basis points, but inflation's 3, 4, 5, 6%, it's already a guaranteed loser. So if there was ever a time that we can think of in our short history, and then looking back over, say, the last 100 years with hindsight, if there was ever a time to have downside protection and true diversification like what we have with our protected portfolio, it's now. The road less traveled, holding the appropriate amount of cash, having downside protection, knowing what our objectives are for each one of you on an individualized basis, and investing to those objectives is the way to navigate the future. It is the way to navigate the craziness that we look at in our space right now with all-time high valuations minus the dot-com bubble. All-time high numbers of Americans still on unemployment benefits. All-time low interest rates. Insane levels, and I don't mean this from a political standpoint, but insane levels of federal government deficit spending, right? That's the world we live in. We can't go anywhere with it. I mean, I guess you could maybe buy a plot of land somewhere out west or maybe in northern Michigan. Oh, that sounds terribly cold, and live off the grid. But even that isn't going to work, right? We have to stay invested in the markets. We have to build wealth for not just today, but for our spending in the future. And so we have to do this in a way that removes fear, removes greed, takes the road less traveled. I'm going to close my part of the presentation and open up for some Q&As. I want to read a couple more paragraphs of FDR's inaugural speech from March of 1933. We're 90 years later, and I think there's pieces in this that are really important. I don't agree with everything that FDR did, but I think this I think this looking back almost 100 years ago can give us some insights into how we should be thinking about today. So let me read a couple more pieces and then I'll wrap up and take questions. In such a spirit on my part and on yours, we face common difficulties. They concern, thank God, only material things. Values have shrunken to fantastic levels. Taxes have risen. Our ability to pay has fallen. Government of all kinds is faced by serious curtailment of income. The means of exchange are frozen in the currents of trade. The withered leaves of industrial enterprise lie on every side. Farmers find no markets for their produce. The savings of many years and thousands of families are gone. Most important, a host of unemployed citizens face the grim problem of existence, and an equally great number toil with little return. Only a foolish optimist can deny the dark realities of the moment. Yet our distress comes from no failure of substance. We are stricken by no plague of locusts. Compared with the perils which our forefathers conquered because they believed and were not afraid, we have still much to be thankful for. Nature still offers her bounty, and human efforts have multiplied it. Plenty is at our doorstep, but a generous use of it languishes in the very sight of supply. End quote. I think that it's really easy to get sucked into the news, into current events, into politics. It takes a disciplined mind to turn that noise down, to recognize where we sit with our emotions, and then realize that the beauty is that we get to choose our response. We get to decide on the path we're going to take. So my encouragement to every one of you watching, clients and prospects if you're on this, is to think about the road less traveled. Is to think about having a clear picture for the life you want to lead, where you want to go, and what you want to accomplish. And then working with our team to align your resources to do that. Turning off the noise, turning off chasing fads, turning off politics, and recognizing that we have a lot to be thankful for. We have an abundance of everything, and we can be a blessing to our family, to our communities, and those around us when we don't live in fear and when we don't live in greed. So my exhortation, my challenge, my hope is that every one of you, including my family, lives an intentional life and lives above the grind. You'll see this on my email signature because it's something that I'm passionate about. Living above the grind for me means passionately pursuing a life of meaning and purpose. And when we get stuck below the grind, which we do, I do myself, we find ways of recognizing and evaluating where we sit right now emotionally and how we're making decisions based on that. And we consciously choose to take the road less traveled. Maybe the more difficult path, but the one with the better outcome, the one with more purpose and more meaning. So I'm going to pause there. I really hope that you found value and that the slides today in our presentation were insightful. Maybe not the most encouraging market update because we painted a bit of a grim picture on the economic side of things. But I really hope you found today's talk to be beneficial in that regards. And just know our team is working through this stuff, thinking about this stuff, analyzing this stuff, and using it to drive how we're thinking about investing and how we're thinking about advising your family in the management of your wealth going forward. So really appreciate you being here. If you've got to jump off and get back to work or other things today, have a blessed weekend. Hope you have great weather, great time with your families. If you want to stay on for a while, I will be on for another, say, 10, 15 minutes doing some live Q&A and answering questions that you might have. And again, the chat section, the Q&A section is right below the video. So if you're in full screen mode, you can exit full screen mode, scroll down, and you should be able to see the chat window. All right, I don't see any questions popping up yet. Again, hope you enjoyed the presentation. Hope you found some value in it. For all of us here at Lifeworks Advisors, we are grateful to get to serve you and your families. My name is Ron Bullis. For those of you that didn't catch the beginning of my presentation, I'm one of the founders and the CEO of Lifeworks Advisors. I hope you have an amazing weekend with your family. Do not hesitate to reach out to anyone on our team if you have any questions about this presentation, your investments, how we're thinking about the current events going on and positioning our investment strategies for the future. Have a blessed weekend, and we look forward to having you on another one of our live events soon.